So Kraken Robotics, ticker symbol KRKNF, it literally just closed at $6.47, and it's riding this absolutely massive 290% upward trend over the last year.
Yeah, it has been an incredibly wild ride for the tape.
Right. But here is the really high-stakes question for you, the listener. With a valuation that is basically touching the stratosphere right now, and analysts flashing some pretty serious warning signs, is this subsea robotics stock actually a strong buy? Or are retail traders just being lured blindly into this massive, inescapable value trap? Because that is exactly what we are tearing apart today.
I mean, it really is the perfect storm, right? You have these incredible growth metrics that are just colliding head-on with some honestly terrifying valuation multiples. So we really have a mountain of conflicting data to sort through here.
We absolutely do. So welcome to today's deep dive into the financial, technical, and strategic outlook of Kraken Robotics. We are going to synthesize their freshly released 2025 record financials, unpack the very messy order flow, and debate this massive acquisition they just announced.
Lots to cover.
Yeah, exactly. Now, before we get into the weeds, I do need to explicitly state that this is purely an educational exploration of the data. Absolutely no financial advice is being given here. We are just analyzing the mechanics, but your portfolio is your responsibility.
Right, definitely.
And hey, if you're finding this kind of in-depth analysis valuable, please like the video, subscribe to our YouTube channel, and it's absolutely compulsory that you drop your take in the comments below as we go through these numbers. We really want to know if you are bullish or bearish on this setup.
Yeah, because our mission today is really to figure out if that $6.47 price tag is the absolute floor or, a very dangerous ceiling. And to do that, we kind of have to start by looking at how they even got here.
Right. Let's establish exactly where the stock stands based on that April 16th, 2026 close. We hit $6.47, which was a pretty solid 4.69% daily gain. But you really cannot understand the psychology of this stock without looking at its historical volatility.
Oh, for sure. The swings are massive.
Yeah, the 52-week range is incredibly wide. I mean, it swings from a low of just $1.57 all the way up to a high of $8.13.
It is a classic high beta play. And, that means it doesn't just track the broader market, it amplifies it. Like, when sentiment is positive, it skyrockets. But when the market gets spooked, it craters.
Exactly.
And that kind of volatility, it attracts a very specific type of momentum trader, which just contributes to those wild swings we are seeing in the tape.
And a lot of that historical 290% run is actually anchored in the fundamentals. So let's look at their FY 2025 income statement, because the top line growth is just undeniable. Keep in mind, these numbers are in Canadian dollars.
Right.
Annual revenue hit $102.2 million, which is up from $91.3 million in 2024. But here's where it gets really interesting, I think. Gross profit margin leaped from 49% to 62.1%.
Yeah, and what's fascinating here is the actual mechanics behind a jump like that. Like in hardware and robotics manufacturing, expanding your gross margin by over 13 percentage points in a single year, that doesn't happen just by tweaking your supply chain a little bit.
Right, it's too big of a leap.
Exactly. It points to a really fundamental shift in operating leverage.
So walk us through that mechanism. Like, how are they extracting that much more profit from every single dollar of revenue?
Well, it usually means fixed costs are staying relatively flat while the revenue scales up, but more importantly, it suggests immense pricing power.
Okay, I see.
Yeah, because in the defense and subsea robotics space, once your technology is integrated into, say, a government or military contract, you aren't really competing on price anymore. You are competing on proprietary capabilities.
That makes sense.
So a 62% margin tells us that customers are aggressively paying a premium for Kraken's specific tech stack. Or, alternatively, that Kraken is successfully attaching really high-margin software and data analytics to their physical hardware sales.
Okay, let's unpack this for a second, because I am looking at the bottom line here. And there is a pretty glaring discrepancy that kind of breaks that whole narrative.
Uh-oh. Let's hear it.
Well, net income is only $2.9 million, which is way down from the $20.1 million they reported in 2024. And diluted EPS is practically flat at just one single penny.
Right.
So if revenue is up and gross margins are expanding that efficiently, why did the net income just drop off a cliff?
See, this is a perfect example of why headline numbers can be dangerously misleading. If you just scan the net income line, you would immediately assume 2025 was a catastrophic operational failure compared to 2024.
Yeah, it looks terrible on paper.
It does, but you really have to look under the hood.
Yeah.
That 2024 figure of $20.1 million included a massive one-time $9.7 million tax recovery.
Oh, wow. Okay, so it wasn't actual cash generated from selling robotics. It was literally just a paper gain from an accounting anomaly.
Precisely. It was a complete windfall. If you strip out that tax recovery and look strictly at adjusted EBITDA, which sits at a very healthy $25 million, or roughly a 24.4% margin, the core business operations in 2025 are actually much stronger.
Got it. So the underlying engine is actually pumping out cash more efficiently than ever.
Exactly.
But wait, hold on. Even if we strip out the tax windfall, expanding margins while simultaneously running a $30.3 million CapEx program, that usually burns a massive hole in free cash flow. Are they actually funding this organically?
That is the multi-million-dollar question. And the answer is they do have what you could call a fortress balance sheet right now.
Okay.
Yeah, as of the end of 2025, they are sitting on $313.7 million in total assets, with $120.5 million in total cash and about $171.6 million in working capital.
So they definitely have the dry powder to fund that CapEx.
They do, and they are explicitly, aggressively investing that cash flow into new manufacturing facilities. They have to build out massive capacity because hardware, unlike software, requires immense physical scale. You just can't fulfill a $100 million defense contract out of a boutique workshop.
Right. So the core business is undeniably printing money and building for the future. But the market really doesn't seem to care right now. I mean, the stock is just pinned at $6.47. What is the tape actually telling us about buyer psychology here?
Well, the short-term technical signals are a complete battleground. We are seeing major divergence in the momentum indicators. We had a recent pivot bottom on March 30th, which actually triggered a technical buy signal and sparked a pretty sharp 19.6% rally.
Which is how we managed to claw back up to the mid-sixes.
Right. But right now, the 14-day RSI is hovering in perfectly neutral territory. It's sitting between 49.6 and 53.7.
So the market is just sort of exhausted.
Yeah, exactly. It is taking a breath and waiting for a catalyst to pick a direction. However, the MACD just showed a positive crossover on April 14th, and that traditionally hints that underlying upward momentum is quietly building beneath the surface.
Interesting. And if we look at the actual price levels, the support floor is currently holding at the $6.21 short-term moving average. And then below that, you have the $5.35 pivot low. But the price is slamming directly into a massive resistance layer right at this $6.47 mark, which happens to be the 200-day moving average.
The 200-day moving average is arguably the most important psychological level for institutional algorithms and retail traders alike.
It's like a brick wall.
It acts as a heavy ceiling, yeah. Every time the price touches it, traders who bought at the top are taking the opportunity to sell and just break even, which creates immense downward pressure.
So who's actually winning this tug of war right now?
Well, the order flow data from April 16th gives us a major clue. We saw trading volume rising right alongside the price increase. And in tape reading, when volume expands as the price hits resistance, it shows real buyer conviction.
So they aren't backing down?
No, it means institutions are actively absorbing all that sell pressure.
You know, I picture this current technical setup like an engine trying to push a submarine through a thick layer of ice. Like the 200-day moving average at $6.47 is that dense freezing resistance, and the price is just scraping against it.
That's a great way to look at it.
But that rising order flow volume, that is the engine revving harder, creating the heat and momentum needed to finally punch through to the surface. And if it does break through, I mean, the all-time ceiling, it has challenges, that $8.13 52-week high.
Right. That is the technical bull case. But this brings us to the great debate. Because if the tape is showing momentum, the valuation metrics are showing something that terrifies a lot of value investors.
Oh yeah, the valuation is controversial, to say the least.
We need to figure out if Kraken is actually an undervalued growth story or just the ultimate retail value trap.
Well, let's lay out the consensus first. Analysts are basically throwing darts blindfolded here. Across the different platforms, we have 11 buys, 1 hold, and 1 sell. But the price targets are staggering in their divergence. Like you have a low target of $4.75.
Which implies a total breakdown of the stock and massive destruction of shareholder capital.
Right. But then the high target is literally more than double the current price, sitting way up at $14. And the average target is somewhere between $7.67 and $11.13. How are financial professionals looking at the exact same balance sheet and coming up with a spread that wide?
It all comes down to how they interpret the valuation paradox.
Right. So what does this all mean for the retail guy? I am looking at a trailing PE ratio of roughly 121x and a forward PE of 106x for 2026. Are retail traders walking blindly into a trap here
This is exactly the psychological trap that destroys retail portfolios.
because of the stock price?
Yes. A trader pulls up the quote. They see a stock price of $6.47, and their brain automatically assumes it's cheap. It feels accessible. They think, oh, I can grab a huge block of shares for a few $1,000. But price does not equal value.
Because that 120x multiple means the stock is already priced for absolute perfection.
Exactly. You are paying $120 today for every single dollar of earnings the company generates. At that multiple, the market is assuming Kraken will execute flawlessly for the next 5 years.
Right.
Any downside risk, any delayed government contract, or even just a broader macroeconomic pullback could trigger massive multiple compression. Like the stock could get cut in half even if the business is still growing, purely because the valuation premium deflates.
And there is a massive fundamental headwind that retail traders might be completely ignoring right now. Kraken just completed a huge $402.5 million public offering.
Yes, this is a critical piece of the puzzle. It completely alters their capital structure.
Let's do the math on that for a second. At the end of the year, their total assets were around $314 million. And they just raised $402.5 million in new equity. That is a gargantuan influx of new shares flooding the market.
Which heavily dilutes the ownership stake of every single existing shareholder.
Right.
It is a mathematical headwind for the stock price. Like, when you increase the supply of shares that drastically, the earnings per share automatically drops, unless net income grows at the exact same exponential rate. That just makes a 120x multiple even harder to stomach for the bears.
But I have to push back here because some very smart analysts are actively arguing that despite that dilution and despite the 120x PE, this stock is technically undervalued.
And their entire thesis relies on the PEG ratio.
Right, the price to earnings to growth ratio.
Yeah.
Because Kraken's growth potential is so aggressive, their PEG ratio is actually hovering near zero. And in traditional financial modeling, a PEG under 1.0 indicates a stock is undervalued relative to its growth rate.
Exactly.
The argument is that if they hit their targets, they will rapidly grow into that sky-high valuation. The E in the PE ratio will skyrocket, which pulls the multiple down organically without the stock price itself needing to drop.
It is a totally valid mathematical argument. If a company is compounding revenue at 50 or 60% a year, a 120 PE today might look like an absolute bargain 3 years from now.
So to figure out if Kraken can actually justify that multiple, we have to look at the upcoming catalysts. And we really have to talk about the massive elephant in the room that is driving all of this speculation.
The Covelya Group acquisition, this is the entire ballgame right here.
Yes, let's lay out the bull case first, like the best case recovery scenario where they hit that $14 price target. Kraken isn't just sitting on its hands. They have a record $87 million in new product orders already announced since January 2026.
Which guarantees a very strong baseline of locked-in revenue to start the year.
And their medium-term 2026 guidance is incredibly aggressive. They are projecting $165 million to $175 million in revenue.
Yeah.
That represents massive 65% year-over-year growth.
Huge numbers.
Yeah. They're also projecting $40 million to $50 million in EBITDA. Plus, there is a major structural catalyst on the horizon, a potential main board TSX listing in 2026.
That listing is crucial. Moving to the main board opens the floodgates for large institutional money. Pension funds, massive ETFs, institutions that are currently mandated to ignore smaller venture-tier exchanges.
But the undisputed crown jewel of this whole bull thesis is the $615 million Covelya Group acquisition, which is expected to officially close in Q2 of 2026.
Right. And if we connect this to the bigger picture, this acquisition completely rewires the DNA of Kraken Robotics. If it's successful, it adds immense strategic scale in the defense and surveillance sectors. It practically transitions them from a successful niche component provider into a prime scaled-up global defense contractor.
Because Covelya brings in all these complementary sensor technologies, totally new government defense contracts, and this massive global footprint.
That is the ultimate grow into the valuation case.
But I can hear the hesitation in your voice.
Sure.
Let's outline the worst-case continuation lower, the $4.75 price target. The bear case.
The bear case is entirely centered on integration risk. Let's look at the numbers you brought up earlier. Kraken had $314 million in total assets, right?
Yeah.
And they did a $402 million share dilution. Why? To fund a $615 million acquisition. Like, acquiring a company twice your size is basically like a snake trying to swallow a hippopotamus.
Oh, wow, yeah. The nutritional value? The revenue is massive, but the digestion process can easily kill you.
Exactly. The execution risk here is monumental. You are taking two highly complex engineering cultures with different tech stacks, different management structures, and different defense clearances, and trying to seamlessly smash them together.
And in the defense sector, you really can't just move fast and break things. If the tech stack integration causes a delay in delivering a major naval contract,
Yeah.
you don't just lose the revenue.
No, you lose the geopolitical trust of your buyer, which is everything.
Exactly.
Mergers of this magnitude destroy shareholder value all the time. Redundant management fights for control, culture clashes cause top engineers to quit, and the sheer administrative distraction causes the executive team to take their eye off the core business.
Which would be disastrous.
If execution stumbles even slightly, like if the Covelya integration is delayed by a single quarter, or if the synergies cost more to realize than expected, that 120x PE multiple is going to completely collapse,
Right.
and the market will punish them brutally.
So, summarizing the timelines for you, the listener, in the short term, over the next few weeks, we are in a high-stakes waiting game. We are watching the tape around that $6.47 resistance level, monitoring the order flow volume, and really just waiting for the definitive headline that the Q2 Covelya deal has officially closed.
Yeah, the short term is completely dictated by technical momentum and news flow.
But the long-term outlook, that is entirely about operational reality. It is about whether this management team can actually digest a $615 million company, hit that $175 million revenue guidance, and integrate Covelya's tech without destroying those beautiful 62% gross margins we analyzed earlier.
The execution over the next 12 to 18 months will permanently dictate the reality of the stock for the next decade.
There is just a massive amount of moving parts here. So I want to remind you one last time. If this deep dive helped clarify the chaos, please like the video, subscribe, and definitely leave a comment below with your own fundamental or technical analysis on Kraken Robotics. Are you buying the breakout momentum, or are you fading the valuation? Let us know.
It really raises an important final thought for everyone to mull over. Kraken has built a formidable cash position, and they have just pushed every single chip to the center of the table with a massive bet on their future. But at 120 times earnings, the mathematical margin for error is literally zero.
So when the dust finally settles on this monumental integration, will we look back at this $6.47 scoring price tag as the greatest subsea bargain of the decade, or the ultimate retail value trap?